There's a company right now that most investors have never heard of. It's not NVIDIA, it's not Broadcom, it's not even one of the hyperscalers like Microsoft or Google, but this company is sitting right at the center of the biggest infrastructure build-out in technology history. And in 2026, it's positioned to deliver the kind of growth that usually only happens once in a company's lifetime. By the end of this video, you're going to understand exactly why this stock could be one of the most explosive opportunities in the AI infrastructure space and why you need to pay attention to it before the rest of the market catches on. Let's get into it. The company I'm talking about is Celestica, ticker symbol CLS on the New York Stock Exchange. And before you say, wait, isn't that just a contract manufacturer? Let me stop you right there. Because what Celestica has become over the last 3 years is fundamentally different from what it was. This is not your typical electronics manufacturing services company anymore. This is a company that has completely transformed itself into a high-value engineering partner for the world's largest AI data centers. And the numbers prove it. Celestica just raised its 2026 guidance. Revenue is now expected to hit $17 billion. That's up from the $12.2 billion they did in 2025. Think about what that means. That's a 39% revenue increase year over year. And earnings per share guidance went from $5.90 in 2025 to $8.75 in 2026. That's a 48% jump in earnings. When was the last time you saw a company this size growing revenue at nearly 40% and earnings at almost 50%? This doesn't happen often. And when it does, you need to pay attention. But here's what makes this even more interesting. Celestica isn't just forecasting these numbers and hoping they happen. They have unprecedented visibility into 2027. Management explicitly said they can see demand extending well into next year. That tells you something critical. Their customers, who are the hyperscalers, the Googles, the Amazons, the Microsofts of the world, have given them long-term purchase commitments. This isn't speculative growth. This is contracted revenue that's already locked in. Now, let me explain what Celestica actually does, because this is where it gets really fascinating. Celestica operates in two main segments: advanced technology solutions and connectivity and cloud solutions. The CCS segment, connectivity and cloud solutions, is where all the magic is happening. This is their data center business, and it accounted for 76% of their total revenue in the third quarter of 2025. Within CCS, there's a subsegment called hyperscaler. This is where Celestica builds custom networking equipment and server platforms for the world's biggest cloud providers. In 2024, hyperscaler revenue was $4.8 billion. That was 50% of total company revenue, and it grew at a compound annual growth rate of 54% over the previous 5 years. By 2025, hyperscaler revenue is projected to hit 57% of total revenue, and by 2027 it could be even higher. What exactly is Celestica building for these hyperscalers? Three main things: custom Ethernet switches, custom AI processors, which are also called hardware platform solutions or HPS, and rack-scale data center networking solutions. Let me break each one down. Custom Ethernet switches are the networking backbone of AI data centers. When you have hundreds of thousands of GPUs or custom AI accelerators all working together in a cluster, they need to communicate with each other at incredibly high speeds. The current standard is 400 gigabit Ethernet. But the industry is moving to 1.6 terabit Ethernet. That's a 4x jump in bandwidth. Celestica is currently working on 10 active 1.6T switching programs that will launch in the second half of 2026. These switches are not off-the-shelf products. They're custom designed for each hyperscaler's specific architecture. And Celestica controls an estimated 55% of the custom Ethernet switch market. That's up from 40% in 2024. They are the dominant player in this space. Custom AI processors are the second category. These are application-specific integrated circuits, or ASICs, designed by companies like Broadcom and then manufactured by foundries like TSMC. But somebody has to take that chip and turn it into a working system. That's what Celestica does. They handle the advanced packaging, the thermal management, the integration with memory modules, and the final assembly into server boards. This is called hardware platform solutions. And it's a high-margin, highly technical business. Celestica's customers include companies building custom silicon for AI inference and training workloads. Think Google's TPUs, Meta's custom chips, and other proprietary accelerators that hyperscalers are developing to reduce their dependence on NVIDIA. The third category is rack-scale networking. This is where Celestica designs and builds entire server racks with integrated power, cooling, and networking. A hyperscaler recently approached Celestica to design a complete rack-scale solution, and Celestica expects to start mass production in 2026. This is a major win because it means Celestica is moving up the value chain from just assembling components to being a full system integrator. That commands much higher margins and creates deeper stickiness with customers. Now here's the critical question. Why is this happening? Why are hyperscalers turning to companies like Celestica instead of buying everything from established vendors like Cisco or Juniper? The answer comes down to three things: cost, customization, and speed. When you're spending hundreds of billions of dollars building AI infrastructure, every percentage point of cost savings matters. Custom silicon and custom networking equipment can deliver 30 to 50% cost savings compared to off-the-shelf GPUs and switches. That's massive at scale. Customization allows hyperscalers to optimize their hardware for their specific AI workloads. A Google TPU is designed specifically for TensorFlow. A Meta chip is optimized for their recommendation algorithms. This level of customization is impossible with commodity hardware. And speed. Hyperscalers need to deploy capacity as fast as possible to stay competitive. Working directly with an ODM, which stands for Original Design Manufacturer, like Celestica, allows them to go from design to production much faster than going through traditional hardware vendors. This trend is called ODM Direct. Instead of buying networking equipment from Cisco, which then subcontracts manufacturing to someone else, hyperscalers are cutting out the middleman and going directly to companies like Celestica. This shifts more value to the ODM and gives hyperscalers better pricing and faster time to market. Celestica has been aggressively positioning itself to capture this trend, and it's working. And let's talk about the numbers in more detail. In the third quarter of 2025, Celestica reported revenue of $3.1 billion, up 28% year over year. The CCS segment grew 43% to $2.4 billion. Gross margin was 8.4%, up from 7.9% in the prior year. And non-GAAP earnings were $1.93 per share, up 81% year over year. For the full year 2025, revenue guidance was $12.2 billion, which represents 26% growth. Earnings per share guidance was $5.90, which is 52% growth over 2024. Those are spectacular numbers. But what's even more important is the guidance for 2026. $17 billion in revenue, $8.75 in earnings per share. If they hit those numbers, Celestica will be one of the fastest growing companies in the entire technology sector at this scale. Now, let's talk about valuation. Celestica is currently trading around $309 per share with a market cap of approximately $35 billion. The stock is up 177% over the past year, and it's up over 3,600% in the past 5 years. That's an incredible run. But here's the question. Is there still upside from here? Analysts seem to think so. The consensus price target from 18 Wall Street analysts is $372.50. That implies a 21% upside from current levels. The highest price target is $420. The lowest is $305. And the consensus rating is strong buy with 15 buy ratings, 2 hold ratings, and 0 sell ratings. But let's dig into the valuation multiples. Celestica is trading at about 3 times sales. That's actually not expensive for a company growing revenue at 40%. For context, NVIDIA trades at over 20 times sales. Broadcom trades at 15 times sales. Even companies growing slower than Celestica trade at higher sales multiples. On a price to earnings basis, Celestica is trading at around 50 times earnings based on 2025 results. But if you use the 2026 guidance of $8.75 per share, the forward PE is only 35. That's reasonable for a company delivering 48% earnings growth. Here's where it gets interesting. If Celestica continues to execute and the AI infrastructure build-out stays strong, there's a scenario where this stock could hit $450 to $500 by the end of 2026. Let me walk you through the math. If revenue hits $17 billion as guided, and they maintain or slightly expand gross margins, earnings per share could actually exceed $9. If the market assigns a forward PE of 45, which is not unreasonable for a company growing this fast, you get to a stock price around $450. If the multiple expands to 50 because of sustained growth visibility, you're looking at a stock price closer to 500. That would be roughly a 60% return from current levels. But let me be clear, this is not a risk-free investment. There are 3 major risks you need to understand. Risk number 1 is customer concentration. Celestica derives the majority of its CCS revenue from a handful of hyperscalers. One customer, which is widely believed to be Google, accounted for a significant portion of revenue in recent quarters. If that customer reduces orders or shifts to another supplier, it would materially impact Celestica's revenue. This is a real risk. Hyperscalers have leverage, and they're constantly evaluating multiple suppliers to keep pricing competitive. Celestica needs to continue winning new programs and diversifying its customer base to reduce this concentration risk. Risk number 2 is capital expenditure and free cash flow. Celestica is investing heavily to expand capacity. They're building a 1 million square foot facility in Thailand. They're opening a massive new plant in Texas. Total capital expenditures for 2026 are expected to be around $1.5 billion. That's a huge number, and it's going to compress free cash flow. Management is guiding for approximately $500 million in free cash flow for 2026. That's down from higher levels in prior years. This is what I call an investment phase. Celestica is spending now to build capacity for future growth, but it means that in the near term, free cash flow will be lower, and the stock could underperform if investors start focusing more on cash generation than revenue growth. This risk is manageable if revenue growth continues, but if there's any slowdown in hyperscaler spending, the high capex could become a problem. Risk number 3 is competition and margin pressure. Celestica is not the only ODM in this space. Competitors include companies like Flex, Sanmina, and even Asian ODMs like Wistron and Inventec. These companies are all fighting for the same hyperscaler business, and hyperscalers have massive negotiating power. If competition intensifies, Celestica could face pricing pressure that compresses margins. We've already seen some early signs of this. Gross margins in the CCS segment are in the high single digits, which is much lower than Celestica's historical corporate average. Management is targeting to expand gross margins to 8% by fiscal 2027 and eventually get adjusted EBIT margins above 10%. But hitting those targets requires continued execution on high-value programs and operational efficiency improvements. If margins don't expand as expected, the earnings growth story becomes less compelling. Now let's talk about the broader industry context. Why is 2026 shaping up to be such a massive year for AI infrastructure? The answer is that hyperscaler capital expenditures are accelerating. According to a recent CNBC report, the top 4 hyperscalers in the US, which are Amazon, Google, Microsoft, and Meta, are expected to spend $700 billion on capex in 2026. That's up from $394 billion in 2025. That's a 77% increase in spending. Where is that money going? A huge chunk of it is going toward AI infrastructure, data centers, custom silicon, networking equipment, power and cooling systems. This is the largest infrastructure build-out in the history of technology, and Celestica is positioned right in the middle of it. Gartner projects that global AI infrastructure spending will hit $1.4 trillion in 2026, up 42% from 2025. Within that, custom silicon and networking are 2 of the fastest growing categories. And Celestica plays in both. This is not a story about one company getting lucky. This is a story about a massive industry tailwind that's going to last for years. The question is, which companies are best positioned to capture it? And based on the data, Celestica is one of the top picks. Let me give you some context on how Celestica compares to other AI infrastructure plays. If you look at companies like Broadcom, they're focused on designing custom chips and networking ASICs. Broadcom is an incredible company, but they're a chip designer, not a manufacturer. Celestica is the company that takes Broadcom's chips and turns them into working systems. If you look at TSMC, they're the foundry that manufactures the silicon. But TSMC doesn't build servers or networking equipment. Celestica does. If you look at companies like Arista Networks, they build networking equipment, but primarily for traditional enterprise and cloud deployments. Celestica is focused on hyperscale AI-specific infrastructure. Each of these companies plays a different role in the value chain. But Celestica has a unique position because they sit at the intersection of custom silicon, networking, and system integration. That gives them exposure to multiple growth drivers simultaneously. There's also a geopolitical angle here that's worth mentioning. Celestica has manufacturing facilities in multiple countries, including the USE, Canada, Mexico, Thailand, and Europe. This geographic diversification is becoming increasingly important as hyperscalers look to reduce supply chain risk and comply with government regulations around domestic manufacturing. The U.S. government, through the CHIPS Act and other initiatives, is pushing for more semiconductor and hardware manufacturing to happen domestically. Celestica's new facility in Texas positions them well to capture government and defense-related contracts, in addition to commercial hyperscaler business. This is another growth vector that the market may not be fully pricing in yet. So here's my bottom line view on Celestica. This is a high-growth, high-risk, high-reward stock. The upside case is massive. If AI infrastructure spending continues to accelerate, if Celestica executes on its capacity expansion plans, and if they continue to win new programs with hyperscalers, this stock could easily be 50 to 70% higher by the end of 2026. The company has carved out a dominant position in custom Ethernet switching and hardware platform solutions. They have long-term revenue visibility, and they're benefiting from one of the biggest technology build-outs in history. But the risks are real. customer concentration is high, capex is elevated, free cash flow is temporarily compressed, and competition could intensify. If hyperscaler spending slows, or if there's any execution misstep, the stock could pull back significantly. For investors, the key is position sizing. If you believe in the AI infrastructure thesis and you're comfortable with volatility, Celestica is a compelling way to play it. But I wouldn't make this more than 5 to 10% of your portfolio. It's too concentrated and too dependent on a few customers to be a core holding. Think of it as a high conviction satellite position. You want enough exposure to benefit if it works out, but not so much that it destroys your portfolio if something goes wrong. Here's what I'm watching closely over the next few quarters. Number 1, are they hitting their revenue and earnings targets? Any miss or downward revision would be a red flag. Number 2, what's happening with gross margins? If margins aren't expanding toward the 8% target, that's a problem. Number 3, are they winning new programs and diversifying their customer base? The more customers they have, the less concentration risk there is. And number 4, what's the competitive landscape looking like? If other ODMs start winning significant market share, that changes the investment thesis. Celestica reports earnings in early February 2026 for their fourth quarter fiscal 2025 results. That's going to be a critical data point. If they beat expectations and raise guidance again, this stock is going to rip higher. If there's any disappointment, you could see a sharp pullback. Be prepared for volatility. This is not a buy and forget stock. This is a stock you need to actively monitor. One more thing. There's a narrative developing in the market that custom silicon is going to take share away from NVIDIA. And to some extent, that's true. Hyperscalers are building their own chips for specific workloads, especially inference. But here's what people miss. The total addressable market for AI compute is growing so fast that there's room for both NVIDIA and custom silicon to grow simultaneously. It's not a zero-sum game. NVIDIA will continue to dominate training workloads and general-purpose AI compute. Custom silicon will take a larger share of inference and specialized workloads. And companies like Celestica benefit regardless of which architecture wins, because they're building the infrastructure for both. That's the beauty of their position. They're not betting on one horse. They're providing the racetrack. If this analysis was helpful, make sure you hit that subscribe button, because I'll be tracking Celestica and other AI infrastructure plays throughout 2026. I'm going to do deep dives on companies like Broadcom, Arista, Marvell, and others as earnings come out. Drop a comment and let me know, are you already invested in Celestica? Or is this the first time you're hearing about this stock? What other AI infrastructure companies do you want me to cover? I read every comment, and I use your feedback to decide what to cover next. And if you found value in this video, share it with someone else who's interested in AI investing. This is the kind of research and analysis that takes hours to put together, but it's worth it if it helps you make better investment decisions. Thanks for watching, and I'll see you in the next one.